Hi, I'm Nick Stenger. We are Stenger Family Office. For the past 43 years, the Stenger family has been helping ExxonMobil families prepare for and leave ExxonMobil. Obviously, right now, there are a couple major changes going on within the company. You may have gotten a PIP recently. You might just be on a regular schedule to retire, thinking about when's the best time to exit the company. Wanted to do a couple of minutes here on this video to explain some of the major factors that you should think about as you look to leave ExxonMobil. I'd say number one, the most important factor here is your age and how long you have until you're going to retire. So if you are 50, that's a much different scenario than being 55. 60 is a much different world than being 55. There's a number of factors to consider when it comes to taking money out of Voya. If you need living expense money, obviously you've got Rule 55 that you can withdraw from Voya if you leave some of the plan there, take a annual distribution from Voya directly, and you will have that ability to generate some income between 55 and 59 and a half. And why is that age important? Because at 59 and a half with Voya, or any traditional IRA for that matter, you are able to withdraw money. You're going to pay the tax, but you are going to avoid the penalty after you hit 59 and a half. So there's a couple of important considerations there. If you're thinking about leaving well before 55, even though, you do need to think about where you're going to generate some income from. Maybe you're looking at getting another job to bridge the gap. And if you are considering getting another job and leaving the company or working somewhere else, maybe as a contractor, I would definitely advise you to have that lined up well in advance before you leave. Obviously, if you're able to afford retirement, if you can leave, whether it's at age 55 or 60 or somewhere in between, and you're already considering retirement, the next biggest step is just to have a financial plan put together. That's the most important piece of this process. So number two, I would advise you, once you figure out where you're at in the spectrum between age 50, 55, 60, wherever you fall in those ages, then I would say hire a good fiduciary financial advisor who knows ExxonMobil inside and out, who can help you put a financial plan together. And what that plan is going to do is it's going to take into account your income, your expenses, your assets, and your liabilities. And those are really the four major buckets of the financial planning process, is taking a look at what can you generate in income from your investments. Maybe you'll have some pension money coming in. Maybe you'll take a lump sum pension from ExxonMobil, and that will require you to generate your own income. So what you want to do is take a look at what's your net income that you're living on every month. Maybe you're looking at your base salary, your total cash compensation, not including RSUs, of course, and saying, all right, out of our monthly expenses, we might have 15 or 10,000 or 20,000 a month coming in to the account in cash. And then we can help you look at, okay, what are the actual dollars that you're going to need? And we have to be very careful with what is the actual dollar amount you're going to need per month in retirement. And this is where people can go wrong. They think they might only need 10,000 a month from their accounts. It may turn out to be closer to 15. And that's a major, major difference. It doesn't seem like it at first. The first couple of years of the plan, it all looks okay, but it's a huge difference when you compound that over a long period of time. So you want to make sure that you get the expense number correct before you make a move. And that's a very important thing to do. You can figure out your fixed expenses pretty easily. Typically, your mortgage is going to be fixed. If you have a car note, that's fixed. If you have regular payments you're making for utilities, and you pretty much know what your grocery bill is, for example, that's pretty easy to figure out. The harder part is the variable expenses, and that's where people can get thrown off. I would look at your credit cards, look at your debit cards. If you have a Chase credit card, for example, you can do a spending summary at the end of the year or even the end of the month and see exactly what you spent. So make sure you dial those numbers in correctly, because if you don't, it could throw off the financial plan. You're going to balance the expense number that you come up with against what the tax rate would be. And we can calculate that for you. Stenger Family Office does function as a multi-family office. So we've got tax, estate planning in-house, and we can help you with all these different factors. But make sure you add in money for taxation, add in money for healthcare. We'll talk about healthcare in a second as well. And then add in money for some of the large purchases. Maybe there's some upcoming major expenses you need to do with the house. Maybe you need to buy a new vehicle. Those are all factored in separately. And once you factor in taxes, then you can balance that against what kind of income can be generated against your assets. So there's a couple types of debt that are considered bad types of debt. I would say anything in the installment loan category, anything in the car loan category, pretty much anything outside of your mortgage. We want to try our best to get that paid down as much as possible. Student loans could be part of that as well. You may not be able to get all of that pay down exactly the second you leave Exxon or retire, but I would definitely recommend have a plan put together where you can get it paid off in about 5 years or less. We do that all the time. And it may actually make sense for you to pay off some of those bad debts over a longer period of time than all at once so that you're not paying extra tax than you have to. You can spread that income out, hopefully stay under certain tax bracket rates. If you're going to leave Exxon and get a new job, that's a whole different story. You can continue to pay those off on a regular schedule. But certainly, if you are going to retire from Exxon, we'd like you not to have tons of debt at that point. Not having debt gives you freedom that it's hard to put a price tag on. And so the common question is, well, if I've got a mortgage at a 3% rate or 4% rate, could I just keep paying that off? And the answer is typically yes. We don't want to rush and pay off a low interest rate loan. But by the time we get about 5, 6, 7 years into retirement, we certainly want to help you get that really paid off so you don't have that burden of debt during retirement. So if you're leaving Exxon and you're going to go take another job, of course, don't pay your mortgage off. Let it keep, just pay it off monthly, and that'll be fine. But if you are going to retire, we just want to have a game plan in place where you will become debt free relatively quickly after leaving the company. On the asset side of things, we typically use a 4 or 5% withdrawal rate. It depends what your rate of return is going to be on your assets. And this is why it's super important to make sure that your financial plan is supported by a strong investment plan. The financial plan is only as good as the investment supporting it. And so if you go in with a 7 or 8% return assumption, make sure that the investments supporting that financial plan can actually produce 7 or 8%. And we see this pretty commonly where people are way too heavy on the bond market, they're way too heavy on cash, and they really don't have enough in the equity market to beat inflation. We typically like our retired clients and pre-retirees, meaning a few years out from retirement, to be at about an 80-20 mix, 80% being stock, 20% being short-term treasuries, not bonds. We're not big fans of the bond market. We like treasuries because they provide you a lot more protection if interest rates go up or stay high. So that's why we use that 80-20 approach. And typically that portfolio, no guarantee, of course, of what's to come, but typically that portfolio can get you through a 30-year retirement without a problem. And as long as you keep your withdrawal rate plus the inflation rate at about the rate of return. So let's say you're taking out 5% plus inflation's about 3. If you can keep the rate of return in the portfolio about 8, you should be okay. That typically works pretty well. This is not tailored financial advice. This is just general information. So I would encourage you, talk to a financial advisor, talk to somebody who's a fiduciary who will put your interests first. You can call our firm for help with this, putting that plan together, or talk to somebody else who will do a good job for you as well. But I would encourage you to get individual tailored advice on that. Now, last 3 quick items to think about here are what to do with your 401k at Voya. Typically, if you're over 59 and a half, it's almost a no-brainer to roll it over because you are going to have much better investment options. You are going to have access to a lot better of a platform typically than what Voya provides. And it does make it easier if you want to have a financial advisor help you with this to roll over that money to an individual IRA account. That's something that we can help you with. Another fiduciary advisor can help you with as well. But don't roll it over until you truly understand what your expenses are going to look like in retirement, especially if you go before age 59 and a half, where we may want to roll over a portion of your 401k, for example, but leave a portion of it at Voya so that you have a place to take some withdrawals from before 59 and a half. Why? So you avoid that 10% penalty. So these are all pieces of the plan. Typically what we like to utilize at Voya, a little bit of inside baseball here is common assets for that safe money. Common assets is not ultra safe like a money market, but it's pretty darn close. And it does take a little bit more risk than a typical money market fund. It's getting about a 6% rate of return right now, which isn't bad for cash. So we like that for a portion of the assets. And of course, on the equity side, we like US equities, and we can tailor that to your individual needs and talk about that on a one-on-one basis. So that's how we look at Voya. Number 2 is the pension plan. So of course, if you leave before 55, you're going to take a much more reduced payout on your lump sum if that's the route you go. a lot of people are asking right now with higher interest rates, does it make sense to take an annuity option and just leave it in the pension plan, let it accrue, and then eventually take an annuity? That's not a bad idea if you spend too much money, if you have kids that you think could be spendthrifts and find out mom and dad, for example, got a big lump sum and are going to come asking for money. I'd say about 3% of the cases we see, the people will go ahead and take an annuity, but about 97% of our families take the lump sum. Part of the reason for that, one of the major positives is number one, you can control where the assets are invested. And number two, long term, it's a great estate planning tool if you do want to pass down money to the next generation. It's really a great way to build long term wealth. So that's why most people take the lump sum. And again, if you go before 55, there is going to be a bit of a downside to taking the lump sum. Exxon did, it was great a couple years ago during COVID, gave everyone the option to take a lump sum. Didn't used to be like that in the past. And so at least you do have an option there. And of course, the closer you get to 55, you're going to have a little bit more availability or a higher amount that you'll be able to take from the lump sum. And of course, accruing into age 62, as you get into that first stage where you're eligible for Social Security, the lump sum will continue to rise according to your age. And of course, if your compensation goes up, that can be a major factor. And then interest rates are the third factor of the pension plan. And this is a really big question we're getting today with higher interest rates. The Fed is actually going to meet this week and talk about this and where interest rates are going. They probably won't do anything in the July meeting this week, but probably by September, there could be some cuts. Just remember, though, we're cutting from 5.25%, 5.5%. So even if the Fed processes a few rate cuts, it's not substantial cuts back to the COVID level where you saw your pension maybe even $200,000-$300,000 higher than it is today. So I would just be careful waiting around for interest rates so you can get a little bit more on the pension. Because remember, if rates do continue to go down, number one, if they go down a lot, it means we're probably in a recession and it's going to be a great opportunity to buy equities, to buy stocks. And stocks should go up in a declining rate environment. We're certainly seeing that on a day like today. So I would just be careful trying to time out interest rates, just like we tell our clients, don't try and time out the market. Also be careful trying to time interest rates because you can give up significant equity upside by waiting for rates to come down. So that's all done on an individual plan. It's all done on a tailored basis. Make sure you're talking to someone who can help you with all these different decisions. And then one of the last pieces, of course, is stock options and what to do with your Exxon stock. Of course, if you leave the firm early and don't retire out, some of those options are not going to fully vest. So we do need to consider some of those factors. And with Exxon trading at all-time record highs, you may want to take some chips off the table. You may want to take some profit depending on how much exposure you have to Exxon stock. We do like Exxon stock right here. It's a great dividend payer. Company's in great shape, but we do want to look at it on a diversification basis and make sure you're not over-concentrated over your entire investments. And then the last piece of all of this to consider is healthcare. Exxon does a really nice job with retiree medical, and it's a really good plan. We've been with Exxon now since 1981, so we've actually seen our retired folks use the retiree medical for a very long time. Of course, the current plan is changing to Blue Cross Blue Shield, so there's a little bit of uncertainty surrounding that. But I think across the board, it will be probably cheaper than some of the other options out there. But you do need to look at it. You do need to look at your costs. We have local Medicare experts, whether you're in Illinois here like we are, or our Houston office. We do have a Houston local office literally across the campus from you. If you know where the Common Bond restaurant is, we're on the fourth floor of that building in Spring. And so we've got Medicare experts we can refer to you locally who can help you with all these decisions. If you're in Baton Rouge, Beaumont, Baytown, wherever you are, just let us know. We'll connect you with somebody who can help you on the Medicare side. And I would definitely talk to somebody who's an expert. I know a little bit about it. We have some information that can be very helpful to you, but it's so nuanced. It's so complicated. I would get you to an expert on Medicare and healthcare decisions as well. So again, we're Stenger Family Office. These are some of the considerations to think about before you either depart Exxon and go look for another job or decide to retire. And these are decisions we've been helping Exxon folks out with now since 1981. We can help you and your family put a customized plan together. Again, our main office is in Naperville, and then we have a beautiful office right across the street from headquarters in Spring. Give us a call if you'd like to set up a plan. 630-912-8295 is the direct number, 630-912-8295. You can also visit us online at StengerFamilyOffice.com. That's Stenger, STENGER, familyoffice.com, and request more information. Thanks so much. We'll see you soon.